Hello, this is the 16th episode of What Would Peter Lynch Do? That explores the wisdom of the legendary investor Peter Lynch. And welcome to the deep dive. You came to us with a really interesting question, wanting to get a handle on market sentiment. Specifically, you asked about the VIX index, then they call the fear index, and also the CNN fear and greed index. You want to know what they actually are, how they tie into, well, these sometimes crazy swings in investor psychology, and crucially, how we can understand all this using Peter Lynch's perspective, his philosophy.
Exactly. And we've gone through the sources you sent over, the articles, the data. Our job here really is to distill the key insights for you. We want to cut through some of the noise surrounding these indicators, look at how crowd emotions like fear and greed really impact things, and figure out how to navigate it all smartly, leaning heavily on what Peter Lynch taught us. Think of it as a shortcut to getting up to speed on this. Let's jump right in.
Okay, sounds good. So let's unpack these tools first. You called them emotional thermometers, which feels right. Let's start with the VIX. What is it?
Right. The VIX. Officially, it's the CBOE Volatility Index, put out by the CBOE, the Chicago Board Options Exchange. And yeah, it's definitely earned that fear index nickname. What it's trying to measure is the market's expectation of volatility, like how much the S&P 500 index is going to swing around over the next 30 days.
Okay, so if the VIX number is climbing, investors are basically betting on choppier waters ahead, more ups and downs.
Precisely. And often that expectation for bigger swings is fueled by, well, fear. When people get worried, they tend to buy protection, put options. And that activity itself helps push the VIX higher. On the flip side, a falling VIX suggests investors are feeling calmer, expecting more stability, less anxiety.
Yeah.
So fundamentally, VIX reflects uncertainty. A high VIX generally signals there's a lot of fear and anxiety baked into the market outlook.
Got it. Okay. And then there's the CNN fear and greed index. That one feels a bit different in how it works.
It is, yeah. It's from CNN Business, and it aims to capture the overall market mood on a simple scale, 0 to 100. Is fear winning or is greed? What's interesting is that it's not just one data point. It's a composite. It actually blends together 7 different market indicators to get its reading.
7? Okay, what goes into that mix?
Let's see. The sources list them out. You've got stock price momentum, stock price strength, stock price breadth, basically how broadly prices are moving. Then there's the put-call options ratio, junk bond demand, market volatility, that's the VIX we just talked about. It's one of the 7. And finally, safe haven demand, like flows into bonds versus stocks. So it's trying to get a wider view.
Right, pulling in different threads.
Yeah.
And interpreting that 0 to 100 score. How does that work?
It's pretty straightforward, actually. 0 up to 49, that's the fear zone. And the closer you get to 0, the more extreme the fear. Like down to your 1 or 2 is extreme fear.
Yeah.
This usually means investors are selling heavily, maybe pushing the market into what traders call oversold territory. 50, right in the middle, that's neutral, no strong pull either way. And then 51 up to 100, that's the greed zone. Closer to 100 means extreme greed. This often suggests the market might be getting a bit frothy, overbought, maybe due for a pullback because everyone's rushing in.
Now, this is really important, and something you specifically asked about, you mentioned 1 to 2, is extreme fear. We need to be clear here.
Absolutely. Let's nail this down. That 1 to 2 reading, that rock bottom level of fear, that applies only to the CNN Fear and Greed Index with its 0 to 100 scale. It absolutely does not apply to the VIX. The VIX, remember, works on a totally different scale. It typically hangs out between, say, 10 and maybe 30 in normal times, but can spike way higher, 40, 50, even above 80 in a real crisis.
Right. So VIX of 2 is, well, it doesn't really happen. It's a different measuring stick altogether.
Exactly. They measure related things, fear, uncertainty, but you can't just compare the raw numbers. A VIX of 30 and a CNN F&G of 30 mean very different levels of fear. Good distinction to make.
Okay, understanding the scales helps. Let's look at how this plays out. The sources gave some really powerful examples of investor psychology driving the market reflected in these indices.
Oh, definitely. Stark examples. Remember March 2020, the start of the COVID-19 pandemic. That was pure, unadulterated fear ripping the globe. Investors weren't carefully analyzing companies. They were just selling. Dumping stocks, almost regardless of the underlying business quality. You could just feel the panic.
Yeah, it was intense. And the indices back then?
They went off the charts. The VIX didn't just climb, it exploded. It hit an all-time record high, even higher than during the 2008 financial meltdown. And the CNN Fear and Greed Index, it crashed right down to those levels you mentioned, 1 or 2. Dead bottom, extreme fear, and the market plummeted over 30% in just about a month. A classic case of emotion completely trampling rational thought.
And then the flip side, the greed.
Well, think about the whole meme stock frenzy in 2021. GameStop, AMC, all that. That was a different kind of extreme. You had armies of retail investors, often coordinating online, piling into these specific stocks. It wasn't about earnings or balance sheets. It felt like pure momentum, social proof, and honestly, a massive dose of FOMO, fear of missing out.
Right. It seemed totally disconnected from fundamentals.
Completely. And the CNN Fear and Greed Index, during that time, it swung way up into extreme greed territory.
Yeah.
Predictably, the prices of those stocks went absolutely nuts, skyrocketing way beyond any logical value before eventually crashing back down hard. It just shows how powerful and dangerous that kind of collective greed can be.
These examples really highlight the challenge, don't they? Navigating this kind of emotional roller coaster. Which brings us squarely to Peter Lynch. He saw this stuff play out time and time again.
Absolutely. For Peter Lynch, understanding and managing your own psychology and recognizing the crowd psychology was just fundamental. It wasn't a side issue. It was central to succeeding long term. He had that legendary quote, "The most important organ in the stock market is the stomach, not the brain."
The stomach, not the brain. It sounds backwards, right? We think investing is all smarts, all analysis. What did he mean by focusing on the stomach?
Well, he meant that while you absolutely need your brain to do the research, find good companies, understand business, ultimately your success isn't just about IQ points or fancy spreadsheets. It's about having the intestinal fortitude, the guts, the sheer patience and resilience to handle the inevitable ups and downs, to stick with your good companies when things look bleak, and crucially, to not get swept away by either the panic or the euphoria of the crowd.
Okay, so let's apply that. When the VIX is spiking like crazy and CNN Fear and Greed is at 1 or 2, what's the Lynch view?
For Lynch, those moments of peak fear, peak pessimism, those were potentially the best bargain sale periods. It makes sense, right? People are selling perfectly good companies not because the business is broken, but simply because they're terrified. He always stressed that you need that stomach to actually step up and buy those quality companies when they're being offered at deep discounts due to panic. He often said he made some of his best investments during really ugly market downturns.
Okay, buying when there's blood in the streets, essentially. And what about the other extreme? When CNN is flashing extreme greed, like during that meme stock bubble?
That's when Lynch would urge extreme caution. He had his famous cocktail party theory. Basically, the best time to be looking for investments is when nobody at the party wants to talk about stocks, but when everyone's bragging about their stock picks, giving hot tips, acting like they're the next Wall Street genius, that's when greed is rampant. And that's the time to be wary. Don't get sucked into buying some random company at its peak just because everyone else is doing it.
And he wasn't big on using these indices to, predict the market's next move, was he?
Not at all. He thought trying to perfectly time the market, guessing the tops and bottoms using indices or anything else, was mostly a waste of energy and often counterproductive. He had another great line on this. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. His advice was always consistent. Focus your effort on finding great companies, understand their stories, buy them at reasonable prices, and then have the patience, the stomach to hold on through thick and thin.
So these indices aren't crystal balls. They're more like contrarian signals, mood rings for the market.
Exactly. The sources used a nice analogy. Contrarian traffic lights. When the VIX is going nuts or CNN Fear and Greed hits rock bottom, that's not a red light telling you to sell everything. For a Lynch-style investor, it's potentially a green light to start looking for bargains. And when the CNN index is way up in extreme greed, that's your flashing yellow light, proceed with caution. The real power isn't in perfectly predicting the turns, but in having that inner fortitude, that stomach, backed by solid research on your companies, to act rationally when the crowd is acting emotionally.
Let's maybe double-click on the VIX numbers again. We clarified the CNN scale, but you asked for a bit more on what the specific VIX levels actually mean, beyond just high or low.
Right, good idea. So the VIX number itself technically represents the expected annualized percentage move in the S&P 500 over the next 30 days. A VIX of 20 means the market is pricing in roughly a 20% annualized volatility range. But practically speaking, most people just interpret the level itself as a measure of fear or complacency.
Okay, so what are the rough ranges people talk about?
Well, based on how the sources break it down. If the VIX is down between, say, 0 and 15, that's usually seen as very stable, maybe even complacent. The market's calm, investors are optimistic, not expecting big moves. Sometimes it feels a little too quiet.
Think the calm before a potential storm.
Could be. Then 15 to 20 is considered pretty stable, close to the long-term historical average. Things feel healthy, no major scares on the horizon. Investors are participating but not overly anxious. The VIX spends a lot of time here. Once you get into the 20 to 30 range, that signals elevated concern. People are starting to notice potential headwinds, maybe interest rate hikes, geopolitical stuff, iffy economic data. Nerves start to fray a bit. You start thinking, maybe I should be a bit more cautious.
And above 30.
30 to 40 generally means real fear is taking hold. This often happens around major unexpected events. Uncertainty is high, and you can see panic selling starting to override cool-headed judgment. And then a VIX above 40. That's generally considered extreme fear, sometimes outright panic. This is usually reserved for major crises, those black swan events. It's often the point of capitulation where rationality goes out the window and people just want out at any price. And as we mentioned, the sources point to 2008 and March 2020, when the VIX went way, way higher, spiking past 80, reflecting true systemic panic.
Okay, so just to summarize that contrast again, CNN fear and greed, 0-100, lower means more fear. VIX, typically 1080 plus R, higher means more fear.
Exactly. And tying it back to Peter Lynch, the key insight is that seeing the VIX jump into the 30s or 40s, into that fear or extreme fear zone, shouldn't automatically make you panic sell. Instead, it should be a trigger to remember, this is what Lynch called a potential bargain sale period. It's about reframing the market's fear into your potential opportunity.
That makes intellectual sense. But, man, actually doing it when the market is tanking, that's the hard part. When your portfolio is bleeding red and the news is screaming, crisis, it feels different. It feels like the world is ending. You asked how to actually stay calm, let alone buy in that moment.
That feeling is completely normal. It's universal. The sources definitely acknowledge that battle between your rational brain saying, buy the dip, and your gut screaming, get me out. And that feeling of, this time it's really different. Everyone feels that in a crash. The whole point isn't to somehow magically eliminate fear. That's not realistic. It's about building a system, a process that allows you to act based on a plan you made when you were rational, instead of letting the panic of the moment dictate your actions. Peter Lynch talked about guts being built through preparation and training. It's not something you're born with, it's something you develop.
Okay, so preparation is the antidote. What does that practical preparation actually involve? How do you build that mental armament, as the sources put it?
Right, the sources lay out a pretty practical three-step guide, really grounded in Lynch's way of thinking. Step 1, and this is absolutely the most critical part, build your lighthouse before the storm. You have to do this when things are calm, when you can think clearly. So first, actually write down an investment thesis for each stock or ETF you hold. Why did you buy it? What's the story? What do you like about it? And this is key. At what lower price would you genuinely be happy to buy more? The S&P 500 ETF example from the source is perfect. You might write, I own this because it gives me broad exposure to top U.S. companies, it's historically beaten inflation, it always trends up long-term, and the chance of all 500 failing is tiny. My rule? If it drops 10% from the high, I'll invest X amount more. Keep that thesis somewhere accessible. Second part of step 1, create a dream shopping list. List those great blue-chip companies you wish you owned but think are too pricey right now. Put specific target prices next to them, prices where you'd feel like you're getting a real bargain, like Company A looks great, but $150 is too much. If it ever hits $110, I'm buying.
And the power of doing that beforehand is...
It's huge. Because your rational past self, the one who did the homework and made a calm, logical plan, becomes the guide for your panicked present self. When the storm hits, you're not trying to invent a strategy while emotionally overloaded. You're just executing the plan your wiser self already laid out. That thesis, that list, that's your anchor, your lighthouse. Okay, step 2 happens during the storm. Conduct a reality check. When the market's crashing and headlines are screaming, pause. Ask yourself honestly, has the world actually stopped functioning around me? Use those simple examples from the sources. Are people still drinking Coke? Have kids stopped wanting Nikes? Did everyone throw away their iPhones? Are the Costco's empty? Almost always the answer is no. Life goes on. The great companies are usually still operating, still selling things. This check helps pull you out of the market panic and reconnect with the real-world businesses you own. It's pure Peter Lynch. Invest in what you know, applied in real time. Then, step 3, disengage emotion and act like a machine. This is where you follow the plan from step 1, regardless of how you feel. The sources call it mechanical averaging down.
Your plan says index down 10%, deploy 30% of cash. Just do it. Click the button. Execute the trade based on the rule, not the feeling. Maybe even stop checking your account balance constantly between trigger points, if that feels too scary. The advice is to start small. Buy just one share of something on your list or from your thesis. Just the physical act of hitting buy when fear is high is a form of training. It builds that mental muscle, that confidence for the next time. And finally, remember history. Zoom out. Look at charts of past crashes, 2020, 2008, 2000 dot-com bust. They all looked terrifying at the time. But on a 10 or 20-year chart, they often look like blips on a long upward journey. It reinforces the rational belief that markets recover, that this too shall pass. So yeah, conquering that fear really boils down to thorough preparation. Lynch's guts isn't fearlessness. It's the confidence born from having done your homework and having a plan before you need it. That's how regular investors can realistically manage the madness.
That three-step process feels very actionable. But there's another fear you touched upon, the one that experts sometimes trigger when they talk about cautionary tales like Kodak or how IBM stumbled for years. It plants that seed of doubt. Could even today's giants, Apple, Coke, whoever, eventually fail? And that can really undermine your confidence in long-term investing.
Yeah, that's a sharp point. And it hits right at the core anxiety of holding stocks for the long run. The sources definitely address this. When people bring up Kodak or IBM, it's a valid reminder. No company lasts forever. No moat is truly permanent. So the big question is, how do you invest for decades with that knowledge? How do you find peace of mind if even the biggest names today could theoretically fade away? Well, the sources really outline two clear paths, two different mindsets to deal with this fallen giant fear. Path number one is the Peter Lynch path. Think of yourself as a gardener. Lynch famously hated the whole buy and forget idea. He said investing is like tending a garden. What does a gardener do? You plant lots of different seeds, your various stocks. You accept upfront that some just won't make it. Some will wither. Those are your Kodaks, your declining IBMs. Your job as the gardener is to periodically walk through the garden, tend it. You need to pull the weeds, sell the companies whose stories are clearly breaking down, like Kodak when digital cameras took over film. And you need to water the flowers, maybe add to the companies whose stories are still strong and growing.
So Lynch's answer to the fear of Apple or Coke failing someday would be?
He'd likely say, of course they could fail. That's precisely why you can't just buy and forget. You have to keep checking the story. Are iPhones still selling? Is Apple's service revenue growing? Is Coke still dominant globally? His solution requires active monitoring. You continually check if the fundamental reasons you bought the company still hold true, and you adjust if they don't. It's a perfectly good approach, but it requires effort, time, and staying engaged. It's the active path. Okay, then there's path two, sometimes called the Warren Buffett approach, maybe. The sources call it the perfect and simple antidote, especially if you don't have the time or inclination to be a stock gardener. Buy the entire league. What does that mean? It means owning a broad market index fund, typically the S&P 500, usually through a low-cost ETF.
And how does owning the whole index solve the fallen giant problem?
Because the index itself is a dynamic system. It's built on survival of the fittest. Think about it. As companies like GE, IBM, Kodak started to decline in importance relative to the overall market, their weighting in the S&P 500 index automatically got smaller and smaller. Eventually, they didn't meet the criteria anymore and were simply dropped from the index. And who took their place? The new giants, the Amazons, the Googles, the Nvidias, the Teslas, they grew into the index. So owning the S&P 500 ETF isn't like betting on just one star player. It's like owning the entire all-star team, which constantly replaces players who are fading with the new rising stars. If Apple does become the next Kodak 50 years from now, its weight will shrink, it'll eventually get removed, but the next Apple, the next big innovator, will likely already be in your index fund, growing to take its place.
Ah, okay. So owning just Apple ties your fate to Apple. Owning the S&P 500 means if one component fails, the system adapts and replaces it, and you benefit from the overall progress.
Precisely. That anxiety, that shrinking feeling you mentioned, often comes from worrying about one specific company failing. The antidote is shifting your focus to owning the system, the dynamic index that automatically weeds out losers and adds winners over time. Understanding that difference, the sources argue, is really key to finding long-term peace of mind as an investor. I will say a word from Peter Lynch today and say that this principle is connected not only to investment decisions, but also to life wisdom. That core idea that guts, that resilience, having the stomach, not the brain, isn't just handed to you, but is something you build through deliberate preparation, through training. That resonates far beyond stocks, doesn't it? Think about any major challenge life throws at you, a tough career move, navigating personal difficulties, anything that stirs up fear or uncertainty. The ability to weather that storm often comes down to the preparation you did beforehand. Did you build your own lighthouse? Did you think through your values, your goals, your why when things were calm? Did you make a plan? That preparation gives your rational self the tools to guide you when emotions are running high. It allows you to act with intention rather than just reacting out of fear. So that discipline of preparing, of building your foundation, It's not just smart investing, it's really smart living. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.